what are the pros and cons of investing in a four-plex or commercial properties, 5+ residential buildings?
So we're talking about residential property across the board.
Yes.
4 units or less are what are often referred to as conforming residential, which means you qualify for all the preferential loan programs that are out there, FHA, general conventional, things of that nature, where you can get lower down payment requirements in order to acquire. You typically get some reasonable funding with regard to terms on those interest rates, etc. When it comes to commercial, which would be 5 units or more residential, that is a little bit of a different scenario when it comes, because the only thing you have available are conventional or investment-oriented loans, like DSCR loans, as an example. Because again, what's happening in the valuations of those two different types of properties are treated differently. Like a residential, which would be 4 units or less, are typically going to be priced or valued based on what other comparable sales in the market have happened. It's compared to what similarly situated properties in the region are selling for. That's how you determine the market price of a traditional residential, meaning 4 units or less. When it comes to commercial residential, the typical valuation metric is not what other properties in the area have sold for. It's what is the reasonable multiple on rent relative to a standard cap rate in the area. That's how you actually value a commercial property. It's based on the net income relative to cap rates for similarly situated properties in the area. But it's not based on what those properties have sold for. What's the cash flow potential of that property? Why is this important? Well, when you're investing in larger properties, meaning 5 units or more, you have an ability to create something called forced appreciation. What's that? Well, that's when you essentially do something that would cause the rents for those properties to go up, but maybe you didn't do a lot out of pocket. Meaning maybe you spent $10,000 to repaint the interior of the property, the units, and maybe that helped you to raise the rent by $100 per month. Again, I'm using simple numbers just to illustrate, because that would translate then to a $1,200 per unit increase in its income, which could translate to hundreds of thousands of dollars, depending on the number of units you have, of increased value for $10,000 to $20,000 out of pocket for paint. That increased value event is referred to as forced appreciation. And why a lot of real estate investors love it is because then you can simply go back to a financing institution and say, hey, listen, now the operating rents are X, they're no longer Y, and I want to take out additional borrowing. I want to borrow additional dollars. And sometimes you're borrowing out all the money that you put into acquiring the property in the first place. And then you're simply then letting the tenants become the funding mechanism for paying down that obligation over time. Even if your net cash flow to yourself goes down substantially, if all of your money is out of the deal, it's still an infinite return. I have a number of clients who go through this process where they'll acquire a property, they'll come out of pocket maybe $100, $200, maybe even $500,000 in year one, but they'll go through this process where they're renovating the units, they're increasing the per unit rent rate based on those renovations, and are able to get forced appreciation to the tune of $200,000, $300,000, $400,000, $500,000. Then they'll go and they'll just simply refinance the property, take out all of the capital that they put into the property, and now the rent roll is what is supporting that debt repayment. So you're getting what is sometimes referred to as the delta, meaning over time, your cost of capital goes down because it's being paid down every month that the mortgage is being paid, right? So the amount of money that's going towards interest is decreasing over time and more is going towards principal. So the actual debt is going down. But what happens over time with real estate? Now, I can't guarantee this, but if you look at history, real estate tends to have an increased value over time. Almost every piece of real estate goes up on average over a 10-year cycle. Again, I can't guarantee that, but that tends to happen. So what happens today is great, but what's interesting is what happens in year 5 and in year 10 and in year 15. The delta, meaning the debt outstanding on the property relative to the new current market value, is substantial. What also happens over time? Rents go up over time. So you're making more and more cash flow potentially over time as well. You're reaping the reward of real estate and getting all the other tax benefits that go along with it. Does that make sense?
Yes. Yeah. It does. And right now I have an opportunity. Let's say I have some money that I can either go, already have a multifamily, and I was noticing that taxes are higher on a commercial property. Interest rate is higher on a commercial property. So I was actually trying to go and focus on a four-plex, but I see what you mean, and it makes a lot of sense.
Yeah, when it comes to tax reduction as well, you have this thing called a cost segregation study, which you can do on the property in order to get something called bonus depreciation. When you're talking about more units, like a heavy unit property, meaning like, let's say you buy a property that has 15 units in it, for instance. On average, when you're talking about smaller unit properties, 4 units or less, on average, only about 1/3 of the property value is going to be available for bonus depreciation. You can only bonus depreciate property that has a useful life of less than 20 years. So the internal components of the property, like the kitchens, the hot water heaters, all of those things are less than 20 years, 15 years or less. So they can be bonus depreciated. But you have roofs, outer walls, all of those are going to have useful life way longer than 20 years. So you can't bonus depreciate that. However, in a large multifamily, you actually have more stuff in that one building that is useful life less than 20 years. Why? In a 15-unit building, you have 15 cabinets, 15 kitchen floors, 15 hot water heaters. You have one roof. The matrix actually works out a little bit better for you from a tax reduction opportunity when you get into the larger complexes. That's why when you see all of these commercial investors and they're going off and they're trying to buy 200-unit, 500-unit properties, the big thing that they're going for is all of the huge potential they have with regard to bonus depreciation, because all of each individual unit has a significant valuation, if you will, that's oriented towards property that's 15 years or less than 20 years. So that gives a huge opportunity for tax reduction. Now, the challenge is when you're acquiring a 200-unit or 500-unit complex, those aren't small dollar amounts that we're talking about. So it's much, 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 much larger investments. So those are typically being done either by extremely large individual investors, or they're happening in syndications, groups of investors getting together, pooling their resources together under one common syndicate, and that syndicate is going out and buying. You've probably heard of a lot of them that are out there. There's tons of them that get touted about, if you will, on social media. The only thing to be concerned about a syndication is the structure of costs. A syndication, you're not only paying for the acquisition of the property, you're also paying for the person who's organizing the syndication, the person who's going to manage the syndication. There are a lot of fees that are built into that complex, which I'm not always a huge fan of. I prefer having much more say over my dollars rather than having them go towards fees and operational expenses.